In February 2025, Bank of America warned that the stock market could be heading for a sharp drop. They argued the stock market was showing clear signs of a growth stock bubble, and they issued that warning while the S&P 500 was hovering near all-time highs. Not long after, the market sold off sharply, falling by roughly 20% in the weeks that followed. Now fast forward 1 year to today, the market is back near record highs, and once again, Bank of America is sounding the alarm. This time, they warned that investors may not be prepared for a correction, and that several familiar sell signals are flashing at the same time. One of the main reasons behind Bank of America's warning comes down to how investors are positioned today. Since the tariff-driven sell-off last year, the S&P 500 has rallied by nearly 40% in less than 12 months. That kind of performance tends to feed on itself. As markets rise, confidence builds. As investors' confidence builds, more money flows in. And as more money flows in, prices get pushed even higher. That feedback loop can carry markets a long way, but it also means positioning can become crowded when optimism spreads too far. And right now, some of the data suggests that may be the case. This chart shows how much of the average household's wealth is now tied up in the stock market. And right now, nearly half of their assets are invested in stocks. That's higher than what we saw during the dot-com bubble in the late 1990s, a period that's now remembered for extreme optimism. At the same time, while stock exposure is at record highs, personal savings rates of the average American are near record lows, sitting at just 3.5% of income. In other words, investors aren't just optimistic, they're already fully invested. And it's not just households. Institutional investors are in a very similar position. According to Bank of America's latest survey, cash allocations among some of the world's largest fund managers have fallen to around 3.2%, one of the lowest readings on record. That matters because cash isn't just a defensive asset, it's also fuel. When markets sell off, cash is what allows investors to step in and buy the dip. But when cash levels are already depleted, that buffer disappears, and that's when markets tend to become more fragile. However, it's still important to note that low cash levels by themselves don't automatically trigger a sell-off.